In this video, I will be continuing with the topic of risk and return. These are the chapters in the reference book for each chapter. Now, the objectives of today's lecture are to understand the concept of beta and its calculation, the CAPM model, security market line, efficient portfolios, indifference curve, and the capital market line. So contribution to market risk beta, that is our first topic. But before we begin with this topic, it is necessary for us to recap what we already know about risk and return. So first thing that we know is that if the risk of a particular stock is high, then the return of the particular stock will also be high. At least the expectation is that the return will be high, so that the investor is compensated for taking the higher amount of risk, right? And then we discussed standalone risk and standalone return, which means the risk and return of one stock. So return can be calculated by average return or by expected return, depending upon which type of data we have. And risk was measured by standard deviation. Okay, so this is an R and this is supposed to be a standard deviation. Now, then we later on discussed that how does risk and return vary when we calculate it for portfolios. So in the case of portfolio, which means when you have more than one stock in your investment pool, in that case, the return of that portfolio is simply the sum of the weighted average of each individual stocks. Whereas we discussed that this is not the case for risk. So if you want to calculate the risk of a portfolio, then it is not going to be the weighted average, the weighted average of each individual stock. So this is not the case because of a concept that we studied over here, which is correlation. So correlation usually is around 0.3 in reality, and if the correlation between two stocks, so if they are partially correlated, you can actually reduce risk, but you cannot eliminate it. So some part of the risk you can eliminate and some part you cannot eliminate. So basically your risk has two parts. One is the diversifiable risk, and the other is the market risk. So diversifiable risk can be diversified away by forming a large enough portfolio and having different stocks, because this risk is unique to each individual firm. So if you have enough number of firms, the profit at one place, the loss at one place will be compensated by the profit of the other place. Whereas market risk is something that happens in the whole broad market. So all of the in businesses or all of the companies within that market get impacted from it, so you cannot avoid it. So if that is the case, if you're forming well diversified portfolios, so if you have a well diversified portfolio, that would mean that you have already diversified all of the risk away. So in that case, the only relevant risk will be the market risk. So you now need to have a measure that can capture the individual stock's relationship with the market. So now let's go to our today's topic. So discard this. That is our today's topic. So what is the contribution to the market risk? It is your beta. It is called your beta coefficient. So the relevant risk of an individual stock, which is called its beta coefficient, is defined under the CAPM as the amount of risk that the stock contributes to the market portfolio. Basically, the market portfolio is a well-diversified portfolios which contains all of the stocks in the market. So basically, market portfolio is supposed to represent the market as a whole. And the tendency of a stock to move up and down with the market is reflected in its beta coefficient. So, like we already said, that now the only thing that is important is that how does your stock react when there is a change in the market as a whole. So, let's say if the stock exchange, the Pakistan Stock Exchange, goes up by 10%, then how does your individual stock in your portfolio react to that change? That is what you're interested in now, because the unique factors of each stock has been diversified away already. So the risk that remains after diversifying is market risk, or the risk that is inherent in the whole market, and it can be measured by the degree to which a given stock tends to move up and down in the market. So the formula for the beta coefficient, it is the standard deviation of the ith stock divided by the standard deviation of the market, and then it is multiplied by the correlation between the ith stock and the market. So if you look at this formula, and now you have understood that beta is the relevant risk measure of a well diversified portfolio. So portfolio that has already diversified all of its risk away. So the stocks, the combination of stocks are such that the diversifiable risk has been diversified away, then the relevant risk measure will only be beta, which is the tendency of how does that stock move relative to the market. So the beta will be high if the standard deviation of the stock is high. So if the standard deviation of the stock is going to be high, it will automatically have a high beta, which means it will have high risk. And similarly, if the correlation between the stock and the market is high, even in that case the beta will be high, which means in that stock will have high risk in your portfolio. In order to understand this even more, let's look at an example. So over here we have three stocks, RH, RA, and L. So basically these are the return of three stocks, H, A, and L, and you also have the market return. So in year 1 the market gave a 10% return, in year 2 it gave a 20% return, and year 3 it went into loss. So now you're interested in that if this is happening in the market, then how are the three stocks H, A, and L responding to these changes? So if you look at H has a beta of 2. A beta of 2 means that it is more risky. Then if you look at RA, it has a beta of 1. A beta of 1 is basically the average risk stock. So it means it will move equal to the market. So such a stock return tend to move up and down on average with the market. So if the market goes up by 10%, the stock will also go up by 10%. And RL is 0.5. So the beta for L is less. So that means it has less risk. If the stock market is going to move by 10%, it's only going to move by 5%. So it's not very responsive to the market. So let's look now what's happening over here. So the stock market moved from 10% to 20%. So that was a 10% increase. Now because H has a beta of 2, that means K, if this increases by 10%, this will increase by 20%, right? Because it has a beta of 2. So if this is moving, the stock market is moving by 10%, this will automatically move by 20%. I'm going to erase some of what I have written. Similarly, when the stock market goes into loss, so 20 to -10, that's a decline of 30%. So when this is the case, over here you can see that the decline is of 60%, because again the beta was 2. So Over here, you gained double. When the market was performing well, you gained 20%, where the market gave a return of 10% more. Right? Because high return is in that place where there is high risk. So if the market goes into loss, then in that case, your profit will go into double loss. This is what's happening over here. Now looking at the next stocks, let me erase this. RA. Now this was an average stock, so it's moving with the market. यहाँ पे 10% change आया, 10 से 20% हुआ, तो यहाँ पे भी 10 से 20% हो गया. यहाँ से 20 से -10 हुआ, तो यहाँ से भी 20 से -10 हो गया. So it's going to move exactly like the market. It's going to mirror the market. And a portfolio of beta 0.5 will be half as risky as the market. So over here, what's happening? This increased by 10%, so this increased by only 5%. And when this declined by 30%, this actually declined by only 15%. So the movement over here is half relative to the market. So basically, if a stock has a beta of 1, then that's an average risk stock. If it has a beta greater than 1, it means it's riskier. And if it has a beta less than 1, it means it's a safer investment. So the higher the beta coefficient, the higher the relevant risk measure, and the lower the beta coefficient, the lower the relevant risk measure. Now you can even see that they have drawn a graph over here, and the average risk stock A, is represented by the yellow line, right? So it's over here, the yellow one. And the high risk stock, which has a beta of 2, has a very steep line, whereas beta L, which is the lowest risk stock, has a flat line. So the steeper your line, the higher is your beta coefficient in that case. And the more responsive that stock will be to a change in the stock market. तो अगर प्रॉफिट होगा तो जिसका बीटा 2 होगा वो आपको ज़्यादा फ़ायदा देगा, ठीक है. लेकिन अगर लॉस हो गया तो वही स्टॉक आपको ज़्यादा नुकसान देगा. So remember the rule in finance that the higher the risk, the higher will be the chance of return over there as well. So moving ahead.